Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have with me once again Rick Rule. He's the chairman and founder of Global Resources Investments, LP, and his firm has been successfully involved in the natural resources industry, investing on a worldwide basis for, quite a while now. Rick and his firm believe that the resource industry investor and speculator are at the dawn of the greatest speculative epoch of his career, and that's saying something because as your host, Rick and I have had many revolutions around the sun, and so. Yes, we've lived through a lot of different cycles. So for Rick to say that, I think it's really something. Today, he is part of the Toronto-based Sprott group. Rick manages close to $1 billion focused on the mining sector through investment partnerships, an investment management firm, and his brokerage firm. And his knowledge and exploration acumen makes him a sought-after speaker for sure. I can tell you, as a person who's gone to many of the conferences where Rick has spoken, he is always one of the keynote speakers, whether he's labeled as such or not. The crowds gather around him because he truly does have unmatched experience and reputation and knowledge. Indeed, his friend and also who's been on this show, investment guru Doug Casey, has said on this show that there's no one in the world who is better at investing and giving investment advice than Rick Rule. So we are indeed very fortunate to have Rick with us once again. Thanks for joining me, Rick.
Jay, thanks for having me. Your intelligent questions always make this show a pleasure.
Oh, well, intelligent questions, if we get intelligent answers, the questions look intelligent. Otherwise, not so much. The global economy narrowly escaped what my good friend Ian Gordon thought was the beginning of a Kondratiev winter. And what Robert Prechter said on the show, he was predicting the start of a new dark age. I mean, so much gloom, so much pessimism, and we have so many people on this show, maybe because gold bugs tend to be pessimists, but you are an optimistic fellow, Rick. It seems to me. I hope you can share some of that optimism with us today. Have all the Keynesians who have shaped policy around the world, I mean, they seem to think we have nothing to worry about. Are you optimistic because you're a Keynesian?
Joe, I'm a credit analyst, which is a nice name for a loan shark, not an economist. I'm optimistic because I have somehow managed to muddle through times that seem to me equally catastrophic for this. I'm thinking about the late 60s and early 70s when I came of age in finance. I'm also optimistic because the ascent of man is the longest unbroken bull market in history. And left to their own devices, people can probably fix almost any error of their own making. If people were inclined in the United States to fix the fiscal problems as opposed to digging themselves in a deeper hole, I suspect that we could be out of difficulty in a generation. As an example, the off-balance sheet liabilities, which I've described on your show with so much trauma, could be obviated simply by repudiating them. They could tell the old codgers like you and me, yeah, we promised you Social Security, we promised you Medicare, but we lied. Too bad, so sad, reset. That would make $65 or $70 trillion in on-balance sheet liabilities go away. Will that happen? Probably not in so many words, but I'm still, at the heart of it, an optimist, which doesn't, by the way, Jay, make me like precious metals any less. It makes me like them more.
All right, so that I guess you distinguish yourself from the Keynesians who hate precious metals and love more government and love more printing press money. Bill Wagner told us just a few minutes ago that profits from non-financial companies after taxes with inventory valuation adjustment. Anyways, if you look at profits, for corporate profits from a perspective of, after you factor taxes out and capital cost and so on and so forth, Bill's description of corporate profits, in fact, I'm looking at a chart from the Federal Reserve that shows a plunge in corporate profits after tax and inventory valuation adjustment and capital consumption adjustment. That's just plunging below, in fact, contracting very substantially. That's not what we're hearing. The mainstream press is telling us that that the stock market is reaching new highs for good reasons because profits are very strong. And indeed, I think I read a recent interview that you did in which you were championing the balance sheets of American corporations. They were doing very, very well. But so are you really bullish on the equity markets and on American business at this point, Rick?
No and yes, meaning I think that U.S. equity markets are becoming overextended. Mm-hmm. Championing the American business sector probably, although the remarks that I made that you read referred really to the very largest industrial companies in the United States, represented by the S&P, where I was attracted to their balance sheets, in particular attracted to the balance sheets that they're resorting to trickery in the same fashion that they used to. Yeah. Except for that the trickery now involves hiding cash in foreign subsidiaries, not making themselves look less strong than they actually are, probably to avoid having to distribute that cash to its rightful owners. Yeah. I agree with the thrust of what you're saying, in the sense that the recovery that the United States is alleged to be undergoing feels to me like a financial recovery. It feels to me like a response to low interest rates and a response to liquidity. What we aren't seeing is a recovery in investments, in capital good investments, investments in the type of capital tools that allow worker utility and hence real worker wages to increase. Mm-hmm. And we aren't seeing an increase in consumption in consumer durables, white goods, and automobiles. The stage is set for that recovery if worker incomes would ever increase, simply because the median age of the white goods inventory and the autos inventory in the United States is at record levels. But I think that workers aren't feeling confident for good reason. Their incomes have been stagnant for a long, long, long time as a consequence, I think, of the corporate sector's nervousness about the political direction of America and the state of the U.S. economy, and hence their unwillingness to make investments in property, plant, and equipment that would position them for a boom that they themselves do not see in the offing.
Yeah, because they don't see the retail, the common folks having the wherewithal to spend, and so to use a Keynesian term, I guess the demand side of the economy is not very strong. I mean, people don't have money; they don't have disposable purchasing power as they once had. The common folks,
particularly in the traditional sense of that word. I have been very fortunate in that so many of my clients and so many of my friends have been in a position personally where either through access to technology or some other fashion, they are part of that subset of Americans. Robert Reich called them symbolic workers that are able to add substantial utility to other people through their efforts, and hence have done very well. We have a bifurcating economy, it would seem to be in the States, where the traditional worker that has enjoyed utilizing capital built up by the innovative American industry had seen real wages rise for many years. Ironically, and I'm interpreting here, the advent of the welfare state began to decrease the effectiveness of the real economic model 20 or 30 years ago, and as a consequence of constant efforts made to help the workers lot seems to have been seriously compromised.
Oh. Well, indeed, and I might just mention, Rick, that the statistics that Bill Lagner mentioned earlier before you came on the show, and the one I just noted, the corporate profits from the Federal Reserve, excluded the financial sector. So those were non-financial corporations that are seeing a really sharp nosedive in profits into negative territory after you take those factors out right from the Federal Reserve balance sheet. Well, some Federal Reserve members have been expressing some concern that the Fed could be behind the curve in inflation. And certainly you and I remember the 1970s with G. William Miller and Arthur Burns before him, how they were printing money like mad, and we started to see the interest rates were rising, but inflation was rising even faster. Do you see prospects of that happening?
I do, Jay. Again, I'm no economist, and I hate to keep making apologies for that. I'm not sure it's anything to apologize for.
I don't know either. I think, honestly, I like to say those with PhDs behind their names from Princeton, Harvard, and Yale are at a disadvantage in understanding the markets, I think. So I wouldn't, if I had some of the most highly esteemed economist, the one there at the New York Times, I think I would probably just shut the radio off or shut him off. But so go ahead. You don't have to apologize on this show for not being an economist. You're probably a better economist than those that claim they are economists.
I'm just not sure where these guys shop. The idea that the CPI represents a basket of goods and services that I consume seems to me very odd. I like to point out that the last couple of years, every day on my way to my office in California, I pass a Motel 6, and the sign variously describes the room price at Motel 6 for between $59 and $109, depending on occupancy. Now, 30 years ago, this was called Motel 6 because a room there cost $6. Now it costs $60. Your listeners need to consider, Jay, whether or not the utility of a room at Motel 6 has increased tenfold over 30 years. After all, I think the sheets are the same sheets. Yeah. Or whether the purchasing power of the denominator has declined by 90% over that period of time. I would suspect that we're dealing with the latter. I would also question the CPI from a much more fundamental viewpoint in terms of as a measure of the cost of living. And that is, Jay, that the CPI doesn't include tax. Now, if they didn't charge me tax, I wouldn't complain quite so much about the index. But the idea that my cost of living is increasing at 2.6 or 2.7 a year, or 2.3, whatever their number is simply fallacious. It's simply fallacious. That isn't what's happening. At the same time, they, and by they I specifically mean the big thinkers and the Fed, have artificially manipulated interest rates lower so that my ability to affect my purchases of those goods and services is constrained because the rewards to the savings that I've done for 40 or so years has been depressed. So sure. I would argue very strenuously that on both sides of their ledger, that they are acting in ways that are antithetical, certainly to me, but also I would suspect to the majority of productive Americans.
I would think so. In fact, Rick, I know I'm quite sure that you've been much more successful than the average person in investing, and you've done that despite the fact that you can't get a reasonable or a market-driven rate on your savings, and in fact, orchestrated theft by the Federal Reserve, by the government, to take from the savers and give to those who dissave, and encourages people really to play what I think is more of a casino in the equity market, and looking for ways to go out in the risk curve and find ways to try to find a way to make up for those lost rates, which is really part of the malinvestment that Austrians understand. But if rates if inflation could rise, I guess you and I are seeing that despite the fact that the demand side of the economy is very, very weak, then shouldn't we somewhere along the way see a rise in interest rates? I think we should anyway, because clearly the government, the Federal Reserve, is suppressing the interest rates. But what is your outlook on rates? Because so many of my friends have lost money betting against a turn in the long-dated treasuries. What are your forecasts for the interest rates, if you have one?
Well, I am, first of all, one of those friends who has lost, as you suggest. So perhaps my remarks are, less useful than they would be if I had a decent track record. I will say that I am surprised by their continuing, and by they I mean the Fed's continuing ability to depress interest rates. I am surprised that the market allows them to get away with counterfeiting, which is of course what quantitative easing is. I am surprised with the level of confidence that exists in financial markets, and I'm surprised by the voter support on both sides of the aisle for manipulating the economy in the fashion that it has been manipulated. The idea that people cheer tapering, that is, the reduction in the amount of quantitative easing, or put differently, a reduction in the amount of counterfeiting that takes place in society from whatever it was, $100 billion a month to $30 billion a month, is astonishing to me. What we're saying is that there is a correct level of currency debasement in the economy, which doesn't make me feel more confident.
Yeah.
But for people who look at things differently than I do, and I think that includes most of the people in the financial services industry in the United States, liquidity, that is the appearance of short-term cash in the system, is such a spectacular lubricant that people have come to believe that liquidity itself is a substitute for solvency. I don't happen to share that opinion, which is why I have less faith in the current system than most mainstream analysts would. My suspicion is that I will be right. My hope is, of course, that I'm wrong.
Sure. No, it certainly makes sense. Well, you know, you mentioned the word manipulation a few times, Rick, and Lawrence Summers clearly understood that if interest rates were suppressed, the general tendency for gold would be to rise, and therefore the need to, according to the GATA folks, the need to somehow suppress or discourage people from buying gold. And it seems to me we see massive smackdowns in the gold price at certain times when you would expect gold should start to rise on global international terrorism or global issues of conflict or economic bad news and so forth. But quite often it's exactly the opposite, and massive amounts of futures markets selling that comes out. Do you subscribe to the notion that within certain limits there may be some games played in terms of taming the gold price?
I'm of mixed minds about that, Jay. I am not by temperament a conspiratorialist. I usually find other simpler explanations to account for the fact that I'm occasionally wrong with regards to my predictions.
Yeah.
I will say that I am very impressed with the amount of physical data at the GATA site. I will say further that my boss, Eric Sprott, firmly believes in manipulation, and I work at a place called Sprott. He doesn't work at a place called Rule. He's been right more often than I have. Further, I will concede that the selling of very large quantities of physical gold and silver at periods of time in the trading day when the volume is very thin would suggest that the seller is not looking for an economic return on his or her metal, but is rather trying to affect the actions of other market participants. I still have a difficult time personally believing that there's been an ongoing 20 or 30-year conspiracy amongst the government and the Council on Foreign Relations and the great big banks and all that kind of stuff. I have a really difficult time for that. But certainly, are all major financial markets manipulated from time to time? Absolutely. If they could and did manipulate LIBOR, periodic manipulation of markets like the gold and silver market would and should be very, very easy targets.
Rick, we're going to run out of time way too soon, so I got to ask you while we're on the topic of gold, what is your outlook for gold in spite of the games that might be played?
Well, it seems to me that you measure gold against anti-gold, which is the U.S. 10-year Treasury from my point of view. The value proposition offered up by anti-gold is that they absolutely positively guarantee to pay you 2.7% compounded over 10 years in a currency where your purchasing power is devalued by my measure about 5% a year, which is a different way of saying they absolutely positively guarantee to strip 40% of your wealth. If I had the choice between gold, which has traditionally, albeit been volatile, but held its value, against an instrument, never mind discussions about the solvency of the issuer, an instrument that promises to strip me of 40% of my purchasing power over 10 years, it would seem to me that the relative direction between those two instruments would be very, very clear. To make it easier for your subscribers to understand, I would much rather be long gold than the 10-year Treasury.
All right. Well, the last time we talked to you, you were very bullish on platinum and palladium. You still feel the same way?
Well, it's kind of you to pick out one of my picks that's worked well, Jay. And I am still very bullish on platinum and palladium, and for the same reasons that existed in your interview. They are not faith-based investments like gold or silver. You can own them for good old-fashioned supply and demand reasons, the way that you would invest in copper or agricultural minerals or any other type of commodities. The fact is that it costs the industry worldwide more to make the stuff than they get for selling it. At the same time, the utility of those metals to consumers on a global basis, particularly in the form of catalytic converters, is very high. I believe the price must go up. I believe the price can go up. I believe that something that must happen and can happen will happen, as it has been happening.
Mm-hmm. You know, David Jensen, who we have on this show frequently, watches the price for the physical platinum and palladium, and he's noting that the futures markets, going out into the future, the prices are much lower than the physical markets, the demand, which I guess is fairly common when you're running into shortages. And of course, we've had the strike in South Africa, which accounts for a great deal of the tightness in the market right now, I suppose. But also, there's been rumors that Russia was going to be buying some of the platinum or palladium, I think, perhaps off the markets. Do you see a long-term shortage, a long-term issue, or do you think that there will be less of this pretty soon if we, once the South Africans go back to work?
The strike in South Africa took about 600,000 ounces of this year's production out of production and used up fabricating inventories that existed. This exacerbates a problem which I think will really rear its ugly head in 2 or 2.5 years. Looking further out, like 10 years out, I believe that markets will take care of the problem, assuming that nobody else intervenes. At a market clearing price in the range of $2,500 platinum, a little less than a double from today's prices, we could produce all of the platinum that we needed in the foreseeable future. It's just that we can't do that at $1,400 or $1,500 an ounce.
Right.
I would suspect that the market will take care of the shortage, given the extraordinary utility that platinum has.
Thank you so much for sharing your wisdom with our listeners. It's always a pleasure talking with you. So thanks, Rick, and I hope to have you back again sometime soon.
Thanks for the opportunity, Jay.